Hey everybody, it's Larry Berman here. What a crazy week on the markets. A lot to unpack this week. And let's start with the US presidential race. I think at this point, most people have probably seen this video clip and others played over and over and over on social media and other places.
How are you incorporating these
I
developments
wanted to see it
into
again.
your decision to stay? And separately, what concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president, but I think she was not qualified to be president.
Okay, wow. There's mistakes and there's mistakes. And it's sad. Like I think in most people's family, you're gonna have some experience with dementia as an older relative starts to experience those things. I've seen it in my family. I'm sure most have. It's pretty clear to 75% of Americans that this is the case. It's sad, in fact, that there's not strong enough voices to convince uh, President Biden to it's time to move on. Now, 4 years from now, it's not going to be any better. 4 days from now, it's not going to be any better. Of course, that's the progression of dementia. Um, Anyways, this is the leader of the free world. Right now, it's pretty clear that Donald Trump is going to be president. I don't see a strong scenario here where that changes. But if I was running things, what I would look to do is try to convince Biden to drop out now and make Kamala Harris the president now. And that should give her enough of a lift, at least to compete at a better level with Donald Trump. It would expose her to the world on the world stage for a couple of months into the election. And obviously, the running mate she picks, is going to be pretty important there. In any case, let's take a look in the chart room and see what we learned this week, because markets reacted to the economic data clearly more than they reacted to slip-ups by President Biden at the NATO summit. Of course, a few hours before that, he introduced Vladimir Zelensky as President Putin. Made a joke of it. Okay, he made a slip, but anyways, let's move on. This is U.S. midterm. This is the probability of President Biden winning the U.S. election in 2024. So U.S. midterms. Since the U.S. midterms, they did relatively well compared to most and compared to expectations. And the expectation for Biden to win again started to go up pretty materially as they ran Donald Trump through the criminal circus, and the impeachments and the lawsuits and everything else. But it appeared a few months ago that Donald Trump was starting to get the upper hand in those lawsuits. It became very, very visible that they were shielding Biden a little bit from public exposure, and we had this big shift. This red line, of course, and this big drop was post-debate. And you see where the odds are now of President Trump. That's so funny. I said it instead of Biden, I said President Trump. So I guess it could happen. I'm pretty sure I don't have dementia, but isn't that funny? Anyways, moving on. Let's look at the charts this week. So what we're looking here is a ratio of NASDAQ QQQ ETF to US small caps Russell 2000 IWM. And this is in percentage terms, and we're looking at the past month. And so, as long as this line's rising, Qs are outperforming the small caps. And the small caps are the ones that are far more sensitive to rate hikes and rate cuts. And so the higher for longer message really, really hurt small caps this year to date relative to large caps. But the inflation numbers that we saw this week, the combination of them, and specifically the CPI report, sucked a bunch of money out of the Qs on Thursday. Small caps rallied. The last time we saw small caps move like this and Qs move like that was during periods of COVID in the March very acute period where there was just so much uncertainty in the world, and we just saw these dramatic swings day to day to day. And X that period, we really haven't seen anything like this before in terms of this magnitude. So to me, this is a really important inflection point, and we saw both small caps and Qs rally on most of the day on Friday, and then a very weak close ultimately for the Qs, the S&P, and a bit of a weaker close for the small caps, although both were up on the day. So when we look at the relative performance here, it's clear that money is starting to rotate. And so this should present more of a headwind for the Qs. This year-to-date chart of the Qs, whenever we see one of these big blue bars, meaning the market opens high and closes low, and we've seen some of them, but year-to-date, this is the biggest magnitude. We saw some here in April when the market started to sell off and consolidate. First big one was in early March. So these are notable. Typically means, okay, we've changed, there's been an inflection point, and ultimately more of a correction. So where does this correction go to? In my mind, we've got to come back to this breakout here where we tested. And so what is that from where we are now? 494, let's call it 450. So about a 10% correction, ballpark, in the NASDAQ. That would be less for the S&P 5 overall, especially if the people are rotating into the other 490 stocks that haven't done well on a year-to-date basis. So, what does this mean when we look at equal weight versus market cap weight world indexes? We've seen this globally. So the average stock globally, led by the US here, started to perform better this week, clearly post these US CPI. So US CPI came here, post that. The average stocks did better than the market cap weighted stock. When we look at the probability of interest rate moves based on US futures, we are now looking at a September rate cut for the Fed. We've seen this come in and out before, but we haven't seen it with this magnitude in terms of what the equity markets did in response to it. So I think the equity markets are starting to believe it. It wouldn't surprise me if the Fed cut rates twice this year. For them to start being more aggressive, we need to see a significant decay in the labor market. This week in Powell's testimony to Congress, he was very, very specific in his reference and his concern about weakening or more imbalanced labor conditions and so forth. So if we continue to see weakness there, that's a big message. The weekly claims this week came back into the range. They haven't continued to escalate. So the last few weeks, maybe it's an anomaly, maybe it's not, but the labor market remains really important here. Between now and the July 31st Fed meeting, nothing. Jackson Hole, if they're going to start the rate cut cycle, is likely the place they telegraph that. Between now and the end of August, they'll see another set of employment data, another set of CPI, and that might be enough. Austin Goolsbee at the Chicago Fed said that he's seen enough. He thinks it's there. He's been a bit more of a dove of late. When it comes to the Canadian market, 75% chance that we get another rate cut on the 24th of July. I would tilt that towards 100, but the market's not fully priced. Certainly by, it's more than fully priced in September, and by the end of the year, 2.5 rate cuts more. And I would tilt, if the Fed's going to do 2, the Bank of Canada is probably going to do at least 2, if not 3. So I would go with that. Again, if they're going to be more than less, the idea there is the weakening economy. If the economy's weakening, taking this all back to the stock market, and the Fed's cutting because of that, money rotates into value, comes out of growth, because a lot of those stocks are not going to see good earnings. Some of in earnings season now, as we're getting into it, we're looking very, very closely at some of those stocks, more of the value names. Banks started off the earnings season. They had a bad day on Friday. And so not a good start there to the value tilt. We'll see how it plays out in the coming weeks. I don't think the markets are telling us they're ready to break out and broaden. That's my spin on things. I think it's a rotation. But ultimately, when you study the end of the cycle and you look at, money flows to what's working, so the Qs, obviously, then it comes out of that, it rotates into what's been beaten up. And the last phase of a market correction is sell everything, get me out. So we're miles away from that. That's where the economic weakness really plays out. Is it later this year? Is it in 2025? That would be my guess. It's a 2025 thing, and markets are probably okay still. So modest correction, modest pullback, led by the tech names. Tape broadens out. S&P doesn't come back at this point more than 10%. Maybe it's 5, 6, 7 kind of thing. That would be probably a little bit healthy at this point. But then can the S&P rally to new highs and keep going? Probably not. You get a failed rally, and then you start to worry about the economy into 2025. So does that mean this week or close to it marks the peak in the S&P? Guess only time will tell. Anyways, have a great one, everyone.